Welcome to Think Global. Today we explore the Wall Street crash of 1929. You need to watch this if you struggle with understanding economic history. The Roaring Twenties, a time of prosperity and excess. The 1920s in America were a time of great economic growth. New technologies like the automobile and the radio were changing the way people lived. Factories were booming, and people were moving to cities for jobs. The stock market was soaring, and many Americans felt they could get rich quickly. This period of prosperity was fueled by consumer spending and investment in the stock market. People were buying goods on credit, and businesses were expanding rapidly. There was a sense of optimism and confidence in the air. However, beneath the surface of this economic boom, there were signs of trouble. Income inequality was growing, and many farmers and factory workers were struggling to make ends meet. Rampant speculation and excessive use of margin buying were becoming common, with investors buying stocks with borrowed money, hoping to sell them at a higher price. Key industries like automobile manufacturing and radio production were at the forefront of this economic boom. Cultural shifts, including the rise of jazz music and the flapper lifestyle, reflected the era's dynamic social changes. Technological advancements and urban development were transforming American cities. Advertising and consumer culture were also on the rise, encouraging people to spend more. Leisure activities and sports events became popular, contributing to the vibrant atmosphere of the decade. But when the market began to decline, panic set in, and investors rushed to sell their stocks, leading to a massive market crash. The crash was further exacerbated by the failure of banks, which had also invested heavily in the stock market, leading to widespread bank runs and financial instability.
Seeds of trouble over speculation and margin buying. As the stock market climbed higher and higher, more and more people got caught up in the frenzy. They believed that the market would continue to rise indefinitely, and they borrowed heavily to buy stocks. This practice, known as buying on margin, allowed investors to purchase stocks with only a small down payment, borrowing the rest from their brokers. While margin buying could amplify profits in a rising market, it also magnified losses when prices fell. As long as stock prices continued to rise, investors could repay their loans and make a profit. However, if prices dropped, they could be forced to sell their stocks at a loss to cover their debts. This created a dangerous situation in which the stock market was increasingly dependent on borrowed money. Any significant drop in prices could trigger a wave of selling as investors rushed to cover their margin calls. And in the fall of 1929, that's exactly what happened. Financial institutions played a crucial role in promoting these practices. Banks and brokers encouraged margin buying by offering easy credit and low-interest loans. For example, advertisements from the era often highlighted the potential for quick and substantial profits, enticing even the average person to invest. Banks themselves invested heavily in the stock market, further inflating stock prices and creating a feedback loop of speculation. This over-speculation was not limited to individual investors. It was a systemic issue fueled by the financial institutions of the time. The combination of over-speculation and margin buying, heavily promoted by financial institutions, set the stage for the catastrophic crash of 1929.
Key events and indicators. The summer and fall of 1929. By the summer of 1929, the stock market had reached unsustainable heights. Stock prices were rising faster than company earnings, and there were signs that the economy was slowing down. Automobile sales were declining and construction was slowing. Despite these warning signs, many investors remained confident. They believed that the market would continue to rise, and they ignored the risks. Some economists and financial experts warned of a possible bubble, but their voices were drowned out by the chorus of optimism. In September 1929, the market began to show signs of weakness. Prices fluctuated wildly, and there were several sharp drops. However, these were followed by rallies, and many investors remained bullish. They believed that the market was simply undergoing a healthy correction. They were wrong. Major financial news outlets reported on the market's volatility, but the general sentiment among the public and investors was still optimistic. Black Tuesday, the day the market crashed. On October 24, 1929, the stock market experienced a catastrophic collapse that would become known as Black Thursday. Panic selling gripped the market as investors rushed to unload their shares at any price. The trading floor was a scene of chaos, with traders shouting and frantically waving sell orders. The Dow Jones Industrial Average, a key measure of the stock market, plunged 11%, its largest one-day percentage drop ever. Stock prices plummeted, and many investors saw their fortunes evaporate in minutes. The next day, the market rebounded slightly, as some investors saw an opportunity to buy stocks at bargain prices. There was a brief sense of hope that the worst was over. However, this proved to be a brief respite. The underlying issues that had caused the crash were far from resolved. On Monday, October 28th, the selling resumed with even greater intensity. The atmosphere on Wall Street was one of sheer panic and desperation. The Dow Jones plummeted another 13%, wiping out billions of dollars in paper wealth. Investors were left in shock, unable to comprehend the scale of their losses. The following day, October 29th, 1929, became known as Black Tuesday. The market opened to a flood of sell orders and prices began to fall rapidly. It was the worst day in the history of the stock market. The panic was palpable, and the trading floor was a scene of utter chaos. The Dow Jones plunged another 12%, bringing its total losses for the week to over 30%. The impact was devastating, with many investors facing financial ruin. Millions of shares of stock were traded, and the ticker tape ran hours behind as it struggled to keep up with the volume. The immediate aftermath saw widespread panic and uncertainty as the full extent of the crash began to sink in.
Section 5. The immediate aftermath. Panic, bank runs, and unemployment. The stock market crash of 1929 had an immediate and devastating impact on the American economy. Millions of investors lost their savings, and banks were forced to close their doors. Businesses went bankrupt, and unemployment soared. The crash triggered a chain reaction that spread throughout the economy. As investors lost money in the stock market, they cut back on spending. This led to a decline in demand for goods and services, which forced businesses to lay off workers. As unemployment rose, consumer spending fell further, creating a vicious downward spiral. The banking system was also hit hard by the crash. Many banks had invested heavily in the stock market, and they suffered huge losses when prices collapsed. At the same time, depositors panicked and rushed to withdraw their savings, fearing that the banks would fail. This wave of bank runs forced many banks to close their doors, further crippling the economy. Personal stories emerged of individuals who lost everything, like John Doe, who saw his life savings vanish overnight. The government initially struggled to respond, with President Hoover believing the crisis would resolve itself. The broader social impact was profound, as communities came together to support one another in these trying times. Eventually, government intervention through New Deal programs aimed to provide relief and recovery, but the scars of the crash lingered for years.
Section 6. The Great Depression, a global economic crisis. The effects of the stock market crash were not limited to the United States. The crash had a ripple effect that spread throughout the global economy, ushering in the period of worldwide economic hardship known as the Great Depression. The United States was a major creditor nation at the time, and the crash led to a sharp decline in American investment abroad. This had a devastating impact on countries that relied on American capital, such as Germany and Austria. The crash also led to a decline in international trade. As economies around the world contracted, countries imposed tariffs and other trade barriers in an attempt to protect their domestic industries. This only served to worsen the situation, leading to a further decline in global trade and economic activity. The Great Depression had a profound impact on societies around the world. Unemployment soared, poverty rates skyrocketed, and social unrest grew. Governments struggled to cope with the crisis, and many people lost faith in capitalism and democracy.
Section 7. Reforms and regulations lessons learned from the crash. In the aftermath of the crash, there was a widespread recognition that something had gone wrong. The United States government enacted reforms to prevent a similar crisis. These included the Securities Act of 1933. This act required corporations to provide investors with accurate information. It also established the SEC to regulate the stock market. The Glass-Steagall Act separated commercial banking from investment banking. The FDIC ensured bank deposits to prevent bank runs. These reforms restored confidence in the financial system. The crash also led to shifts in economic policy, emphasizing the need for government intervention in the economy. Long-term effects included changes in investor behavior, with a greater focus on risk management and diversification.
Section 8. The New Deal, government intervention in the economy. The Great Depression also led to a fundamental shift in the role of government in the American economy. Before the crash, the prevailing economic philosophy was laissez-faire, which held that the government should not interfere in the free market. However, the severity of the Depression forced the government to take on a more active role. In 1933, President Franklin D. Roosevelt launched the New Deal, a series of programs and reforms designed to provide relief, recovery, and reform to the American economy. The New Deal included programs to create jobs, provide unemployment insurance, and regulate the banking system. Key figures in these efforts included President Roosevelt, Secretary of Labor Francis Perkins, and economist John Maynard Keynes, whose ideas influenced many New Deal policies. Specific policies included the Social Security Act, which provided pensions for the elderly, and the Wagner Act, which strengthened labor rights. The New Deal marked a significant expansion of the federal government's role in the economy and laid the foundation for the modern welfare state. While the New Deal did not end the Great Depression, it did help to alleviate some of its worst effects. In the long term, these interventions established the principle that the government has a responsibility to promote economic security and well-being, influencing future policies and contributing to post-World War II economic growth.
Section 9, The Legacy of 1929, a turning point in American history. The Wall Street crash of 1929 and the ensuing Great Depression were watershed moments in American history. They marked the end of the Roaring Twenties and ushered in an era of economic uncertainty and social upheaval. The crash and the Depression had a profound impact on the lives of ordinary Americans. Millions of people lost their jobs, their homes, and their savings. Families were torn apart and communities were devastated. The crash also led to a loss of faith in traditional institutions such as the government and big business. People began to question the capitalist system and to demand greater economic equality and social justice. The legacy of 1929 continues to shape American society today. The reforms and regulations enacted in the aftermath of the crash have helped to create a more stable and resilient financial system. The New Deal programs established a safety net for the most vulnerable Americans and laid the foundation for the modern welfare state. The crash also influenced future economic policies, leading to ongoing debates about regulation, market stability, and the role of government in the economy. The financial industry evolved significantly, incorporating lessons from the past to prevent future crises and to adapt to new economic realities.
Section 10. The importance of financial literacy and regulation. The Wall Street crash of 1929 highlighted the need for financial literacy and regulation. The crash was partly due to a lack of understanding of the stock market. Today, financial literacy is crucial. It involves budgeting, saving, and investing. Programs like these have empowered individuals to make informed financial decisions. Effective regulation is essential to prevent financial crises. Regulations must evolve with new financial products and practices. Measures like the Dodd-Frank Act and the establishment of the CFPB have strengthened financial oversight and consumer protection.
Section 11. Echoes of the crash financial crises of recent times. The Wall Street crash of 1929 shares similarities with more recent financial crises. For instance, the Asian financial crisis of 1997, the Russian financial crisis of 1998, and the global financial crisis of 2008. All these crises highlight the interconnectedness of the global financial system and the ripple effects of market failures. By comparing these events, we can identify patterns and differences, learning valuable lessons to prevent future economic downturns. The Wall Street crash of 1929 marked the beginning of a prolonged and devastating economic downturn known as the Great Depression. This period saw unprecedented levels of unemployment, widespread poverty, and a significant decline in industrial production. Families across America faced dire hardships, with many losing their homes and livelihoods. In response to the widespread economic despair, President Franklin D. Roosevelt introduced a series of New Deal policies aimed at providing relief, recovery, and reform. These policies included the creation of Social Security, the establishment of unemployment insurance, and the implementation of various public works programs to generate jobs and stimulate economic growth. While the New Deal policies provided some relief, The road to full economic recovery was long and challenging. The Great Depression left a lasting impact on the United States, reshaping the nation's economic policies and attitudes towards government intervention in the economy. The long-term economic impacts of the Wall Street crash and the Great Depression continue to be felt today. The lessons learned from this period have influenced financial regulations, economic policies, and the importance of maintaining a stable and resilient financial system. As we reflect on this pivotal moment in history, it serves as a reminder of the enduring need for vigilance, regulation, and financial literacy to prevent future economic crises and ensure a more secure and equitable future for all. Thank you for watching Think Global. Don't forget to like, share, and subscribe for more insightful content.